Welcome back in. If you're just tuning in, this is Lowcountry Money Talk, and we are talking a little bit about current events and how things are going. Phil Bloyd is here, of course, to help us walk through some of this. And it's nice to have you back.
All right, I'm here. Let's get down to it.
It's time to buckle up. We're going to get really down to brass tacks here, because we talked a little bit about how things are going and what this might mean, but we're also going to talk a little bit about really, the bear market, what history has shown us, what we can stand to learn, and how things have been the last couple of months. So I guess let's start there.
Let's do it. So as an investor, it's important to know where we're at so that we can position, for future ups or downs or whatever it may be. I work mainly with retirees and soon to be retirees, more so retirees. So, retirees are special because they have to take mandatory distributions, many of them at age 72. So if they don't have their assets properly placed, they may be selling assets at a much lower rate to take mandatory distributions, which means if the market turns around, they don't have the investments to come back with it. So that can deplete their savings much faster. So the first thing I'd like to talk about, Jessa, is where we're at in the history of bear markets.
Okay.
So if we look at the Standard & Poor's 500 performance on charts from 1929 to 2020, what has been noted is that there's a bear market about every 5 years or so. Okay, so in a bear market, typically that index will go down about 39%. And as we sit here today, I believe it's down about 16 or 17. For the year, I think the most that it's been down is 22 or 23. Now the NASDAQ index has been down over 30%. And as we sit here today, I believe it's 23%. So the average decline is 39% on the Standard & Poor's, and we're at 17.
So history shows us likely we haven't hit bottom.
Maybe not. It's always hard to call. What's the fancy word they use for the bottom is capitulation.
Oh.
You ever heard that one? Transitory inflation.
Yeah, right. All these great words thrown around.
Who knows when that will be or whatever, but in the course of a bear market, you have rallies inside the bear market. So I think to this point we've had about 4 rallies since we've been in that bear market. So in July we had a rally within the bear market. So to remind our viewers, a bear market is defined as being 20% off the highs. And to get out of the bear market, guess what? We had to be 20% off the lows. So pretty simple. I was gonna guess, but I was no rocket science there. So history would say that we've got a ways to go. So just as the gas prices pull back a little bit, we have a rally in July in the market. I believe the market in July was up 10%. In June, it was down 10%. So that means you're not really even 10%. Oh, I was down 10%, I'm up 10%, I'm even. No. I had $1 million, I'm down 10%, I lost 100,000. I got a 10% return on 900,000. I'm back to 990, not $1 million. So
you're still down.
Still down. Okay.
But we're feeling a little bit good.
We feel good because the momentum shifted. But will we be able to maintain? So what I would tell the viewers to do is now would be a great time to look at your portfolio since we've had that bump, and make sure that you have the right amount at risk in comparison to the right amount that's not at risk based upon your age.
Well, that's one of the things that is so evident about discussing this with you, these trends and how things are going right now, is that there is something you can do about it. You don't just sit around and watch it happen, right? And you really need to dive in and make sure that your assets are in the proper locations. So you all can help us with that, actually. Rachel over at Revolutionary Financial Group can help you set up an assessment and a portfolio analysis so that you do know where you're at right now, so you can make those adjustments. So we need to make sure we're doing that. We got a lot more to talk about. We're going to do that after the break and really kind of dive more into bear markets and what you can do to plan for retirement, or what you can do if you are in retirement. So some heavy hitting stuff.
Got to do it.
Coming up after the break. Stick around.